Hello friends. A very good evening and namaskar. My name is Anindya Banerjee. I am heading the research in currency for Kotak. Since we last met online, a lot of movement has happened in dollar rupee. We had seen a low of 69.5 from 74.5, and it had say bounced back to 72 and come back to almost 69.90 in the morning today. Uh, so in this webinar, I'll be just now talking about the view ahead because I received a lot of questions and I've been traveling across the general say query was of clients is that and on of prospective clients as well is that they want to understand what this currency market is and how they can trade with Kotak in currency. So in this webinar, I'll be also taking you through once again the basics of currency, how you can trade on the online platform as well as offline, and obviously, I'll be covering the factors as well as the view ahead. With this, let me start the presentation. So the name is quite interesting, right? FX derivatives, it's a trader's gold mine. Now, the word traders is very important because this is not a market for investors. This is where you go in and out. So it's like I presume a lot of you, if I give you a comparison, how many of you love a test match cricket and how many of you actually love a T20? So I presume I can safely say most of you would love a T20 match over a test match. So if that be the case, then you are a trader. If you love test match cricket, then you can say you are an investor. And FX market, the currency market, is a gold mine for traders because here you can trade in opportunities which last just a few hours, even to 1 hour, and obviously a lot of opportunities intraday. You don't have to take the risk of carrying the positions overnight, and obviously a couple of days of trading opportunities are also there. So I'll be taking you through all of those. First, let me give you a glimpse of this huge market. It's a humongous market. Means how much you could actually tap into. Just have a look. It trades $5.3 trillion a day. How big is that? Indian annual GDP is around 2.5 trillion. So the global currency market trades double, more than double, the Indian annual economic size every day. And compared to what happens in the stock market, this is huge, right? Now, in India too, this market is fairly large. We trade around 40,000 to 45,000 crores a day on the NSE and BSE and MCX combined. So this market is growing and growing quite rapidly. Just look at this growth. This is takes into volume the consideration the NSE and the BSE. We have seen a significant increase in the volumes this year in FY19. We expect this growth to continue because the regulators are wanting to give access to individual traders into this market. The banks are coming in, and this market has all. You have participants like individual traders like you. You have institutions like banks, hedge funds, FI clients, corporates like importers, exporters, and you also have central banks into this market. So this market has all, and it has opportunities for everybody who wants to protect their risk, who wants to make money out of it. It's all there. And the kingpin of this market is dollar rupee. Now, a natural question comes, okay, fine, this market is large, everybody participates, but why should I be interested as an individual investor or an individual trader? Three reasons. One is lower margin requirement. This is a big thing. In dollar rupee, the margin requirement is 3% or less. If I take Nifty futures, it's 11%. For some stocks, it could be as high as 25%. Now, one can easily ask a question that, okay, in dollar rupee, the margin requirement is 3%. On Nifty, it is 11% because the intraday volatility in Nifty is pretty high. So it is it is around 4 times larger than the dollar rupee. That's not the case. Why? Internationally, it is the norm that the margin requirement, the margin percentage, is in sync with the volatility in the instrument. So if a particular instrument is more volatile, the margin is automatically higher. If the particular instrument is less volatile, the margin requirement is lower. That's how it should be in a sensible framework. But in India, unfortunately, the regulator is trying to impose a kind of a penal margin. They are trying to use the margin as a disincentive to push the individual investors out of the derivatives market because of the old saying that derivatives is a weapon of mass destruction. That's an unfortunate description of an instrument. It's like saying electricity is harmful. Electricity is not harmful if I use it responsibly. If I put my hands or my finger into a plug point, yes, it can take my life away. At the same time, electricity is literally defining our modern civilization. So it is not the derivatives which is harmful, it's how people use derivatives and how brokers and advisors advise clients to trade into derivatives. So because of which we have seen equity derivative margin go up significantly. So if I give you a choice, like a hypothetical question that if there are two markets, in one market you can invest or you can utilize 1 lakh rupees to capitalize on an opportunity to make profit of 10,000 rupees, compared to another market with a similar risk profile. There you use a margin of or a investment of 20,000 rupees to capitalize on a profit making opportunity of same 10,000 rupees. Which one will you choose? It's a no-brainer. Obviously, everybody will choose the second option because there the risk profile is same. You can make the same amount of profit if your trades are right, and the capital deployment is 1/5 of the previous. That's exactly why currency derivatives stand out over the equity derivatives. You are a trader. You are agnostic. You do not give a penny, or you do not really care whether you trade equity or you trade currency. As long as both markets are liquid, they are fair and free to trade, and you will always make sense to choose a market which has a lower margin deployment. So currency derivative stands out. So it has significantly lower margin deployment with a high volatility. Now, the second reason is there is no bull or bear trends. Why does it matter? It matters because, unfortunately, in equity, volumes completely dry up when there is a downtrend. Though through equity derivatives, you can always short, you can always go long, but that's not how people react, because people are psychologically more tuned to buy something and then sell, not sell something first and then buy it back, because of the psychological makeup that, which is also a fact that a thing can go to unlimited levels. A stock which is priced at 1 rupee can go to even 10 lakh rupees or more, but a stock which is at 1000 rupees can maximum fall to zero. But because of which people are more comfortable to buy something than to short. But in dollar rupee, this is only, though I would not say it's an asset class, the only market in the world which trades always a ratio. You don't say dollar, you say dollar against the rupee. So when we say, let's say 70, it means what? 70 rupees per dollar. That's the case with any currency. That's why we always say currency pair. So no other asset class or no other market in the world, like commodities, bonds, or equities, they trade in terms of a pair or a ratio. It's always absolute. You say Indian bonds, let's say Indian 10-year government bonds is currently at 108. That means 108 rupees per bond. The Kotak Mahindra Bank stock is at 1300 rupees. So it is 1300 rupees per stock. So it is always absolute. But in the currency market, it's a ratio. So therefore, if something, let's say dollar rupee goes from 70 to 74, it's a bull market for the dollar, but it's also a bear market for the Indian rupee. Similarly, if it comes down from 74 to 69, it's a bear market for the dollar, but a bull market for the rupee. So volumes are always there as long as it is trending, it is going up and down, and that's what it does. So that's the reason why this market is fantastic. Third point, longer trading hours, which is big because uh, in the uh, in the equity market you can trade between 9:15 to 3:30. Though there is a talk of extending the trading hours, but that's something which may happen in the future. As of now, it's up to 3:30. In the currency market, in the rupee pairs like dollar rupee, euro rupee, pound rupee, yen rupee, you can trade up to 5. In international currencies on the NSE or BSE or MSCI, you can trade up to 7:30. So that's it has longer trading hours. Why it's important? Because I know of clients who who don't trade throughout the day. So they come, say, 1 or 2 hours in the day and spot trading opportunities and trade. So when you have a longer trading hours, you have a lot of flexibility to complete your work, which you are doing, and then focus on the market. So that's a third advantage. Fourth advantage, though I have not mentioned on the slide, it is extremely hard. I'm not saying impossible, but extremely hard to manipulate a currency which trades fairly well. Though it's the same case for a Nifty or an index future like a bank Nifty, but that's not the case with stock futures, because in stocks we all know there can always be an insider and insiders. So they're always at a disadvantage. In currency market, there is no insider. There are only institutional players and individual players. Even the central bank can't dictate where the dollar rupee will be over a period of time. They can influence the price, let's say today in the moment if they come and buy or sell, but they cannot dictate the trend. So that gives you a tremendous advantage, because as an individual trader, what you need is a game which is free and fair. Because if the game is loaded, if it is loaded against you by insiders, then it's not a game. It's not where a trader should be. Your charts won't work, your trading strategies will fail, because you always are playing a loaded game. So currency is nearly a fair game, so it makes sense to focus on that market as a trader. Ultimately, you are just focusing on one instrument. If you want to just start trading, you don't have to make things quite complicated. You just focus on one instrument or one pair, that is dollar versus the rupee. You can focus on the options, you can focus on the the futures. Now we have weekly expiries, weekly options on dollar rupee. That's big. So that, and the volume is picking up. So you can focus on that, and you can start trading. In equities, there are thousands of stocks. Even on the indices, there are a few of them. So one particular day, one particular stock can move. On another day, another stock can move. So you have to always know which one is moving when. Here, you are just focusing on one currency pair, dollar rupee. It will move anyways, up or down. So you, as a trader, you have the entry point in place, the stop losses in place. You can play. You can take small bets and play this market. So this is a fantastic market, a perfect setup for a trader. Now, there are a couple of conventions in this market. As I said, this is a pair, this is a ratio. Uh, so this part I have already explained you. Like if it goes from 75, from 74 to 75, what it means and all that. So I'll skip this one. Now, how can you? Because this is a question which I got a lot. I was in Delhi and Moradabad over the past couple of days, and this is a constant question which I heard from the individual investors or individual traders. Is that how can we trade the FX market on the Kotak terminal? So one is that if you are offline client, if you have a dealer through whom you trade, then you can simply ask your current dealer or your RM, your sales representative, to activate you on the currency market. There are no other documentation is required, because your KYC is already done. You just need to check mark on a particular form, and you just need to give a tick. And even you can do the same online. You can go, if you're online, if you're once you have the online access, you can go to the website and do that, give the consent. So it is as easy as that, and everything is same as equity as far as the transfer of margin and everything. So here I'll just give you a glimpse of how you can trade through the online platform which we have called Keet Pro. So on the online platform, if you see, on the top we have this new watch list. You can create a watch list just like the one you have created in equity. Then you just go on the blank screen and do a right click. And once you do a right click, a pop-up is going to come like this. So you do an ad script. Then on the ad script, you have to type a pop-up box is going to open. Here you have to type the USD INR. Uncheck all of these boxes. Just keep the NSE checked. Keep the futures checked, assuming that you're doing the futures will come to the options later. You have to also select the expiry date here, like I have selected the 27th of December, and then automatically it populates. Okay, the dollar rupee, you just do click OK, and it's going to come. So once you do that, this is how you create the checklist. The first four currency pairs represent the currencies against the rupee, which trades up to 5. The next three are international currencies which don't have a rupee leg, like the pound dollar, or called the GBP USD, Euro USD, and USD JPY. This trades from between 9 to 7:30. So that's how the watch list will look. Now in the options, you do the same thing. Only here you check options instead of futures. You have to you can also select the strike here, and accordingly it will pop on your screen. So that's how you can set up your watch list on your Keat Pro terminal, and you can start trading. In fact, initially I would suggest that you watch this market on a daily basis, because it is very important when you are starting off to have a feel of this market. So create the watch list, just see how the prices are moving. And for charts, because a lot of you would be interested to do technical analysis and watch this market, go to a site called tradingview.com. It's a fantastic interface. You can use your existing your Gmail IDs to create a free login, and you will be able to access, I think, almost all of the charts in the world, even cryptocurrencies. So even the dollar rupee is there, Brent is there, Nifty is there, Indian stocks are there, all are there, and it's all free. Maybe there is a delay. You can create beautiful charts on that, and fantastic interface. So that is also, so on one hand you have this watch list created on the Keat Pro. You also create a chart. You can create a chart interface, or what we term as a uh, uh, you can create a workspace on the tradingview.com, and which you can retrieve every day. And third, you have, in order to look at the international markets, you can go to investing.com. It's a fantastic site. Again, it's completely free of cost. You can again use your Gmail credentials to create a free login ID, and there you can create a uh, market watch for international equity indices, uh, for crude oil, because these are markets which have an influence on the dollar rupee, and trade, also keep a track on international currencies like the euro dollar, pound dollar. In fact, the euro dollar, pound dollar, and dollar yen you can see easily on your screen on Kotak Pro, like over here. But still, to just keep a tab on all the international currencies, just to see how dollar is doing internationally, because if on a particular day dollar is rising against every currency, then it's kind of an index effect. It's like Nifty rallying. There's a high probability that stock, then almost all of the stock may do well. Similarly, here, if the dollar is rising significantly against every other currency in the world, it will have a negative impact on the rupee. So that's why these market work. So I'll just, I'll go through it once more. You create the market watch on Gate Pro. Go to the tradingview.com to create the chart interface. Go to investing.com to create the market watch on international equity indices, international currencies, and for crude. These three things have an impact on an hour to hour basis on the dollar rupee. So that will set you up to trade in this market. Now, with that, I'll move to what drives the dollar rupee, because unless I give you a perspective to analyze how I am arriving at a view, it's of no use. then I'll just come here, give you a gyan, and go away. It's of no point, right? So let me give you a perspective which will help you to frame your own view, because on a daily basis you need to do that. And I'll give you a short story. When I joined this market 15 years back, the first thing I did was to go and talk to the other analysts, economists, people in the media, to actually get a hang of what really drives the currency market. For example, dollar rupee. I was damn confused. I was absolutely confused because everybody gave me some or the other new factor to track. So I was initially I used to think, is this market so complicated? Over a period of time, I started to delve into it and started to develop my own perspective. I realized it is very simple. Things are made extremely complicated in the financial industry. It is not so complicated industry after all. So what really drives a currency, in this case the dollar rupee, is just flows. There's too much of jargons thrown about: trade, current account, etc., etc. No, it's not. Yeah, it's simple. What really drives the currency is flows. If you have dollar coming into India, the Indian rupee will appreciate. If you have dollar coming going out of India, the rupee will depreciate. It's as simple as that. It is common sense, right? So what I have done is I have segregated the flows into three categories. One is capital flows, as I said. So you have the FIIs who are either investing into India in the Indian equities or bonds, or taking money out of India. That's constantly happening every day, every moment, in fact. So that has an impact on the dollar rupee. If the dollars are coming in, bad for dollar, good for rupee. Dollars are going out, it's bad for the rupee, it's good news for the dollar. Simple. Second kind of flows which have an impact is the positioning of the traders. Like you and me trade, uh, the institutions trade here. We have also a very big dollar rupee market abroad, which is called the NDF market, non-deliverable forwards. There are exchanges in internationally, SGX, you have DGCX and CME, which trade on the dollar rupee futures and options, and they are picking up volume a lot. It is estimated that the international market is almost equal in size, maybe a little less, compared to the onshore market or the domestic market on dollar rupee. Now here, when people the speculators take positions, it has an impact on the direction of the dollar rupee. So if a large speculator comes in, let's say, and sells uh, $1 billion of dollar rupee futures on the domestic exchanges, on the bank, or on the international exchanges, or in international banks, which is NDF, it will create downward pressure on the dollar rupee, right? So it's kind of like a pseudo flow of dollars into India, or the other way around. If the same speculator comes and start buying dollars, what happens? It as if a pseudo outflow from India. It has an adverse impact on the rupee and a positive impact on the dollar. So third category of flows is the positioning of the traders in the derivatives market. It has a big impact. Uh, the final one is the RBI intervention. If the RBI is buying dollars, for that moment it will have a positive impact on the dollar and a negative impact on the rupee. Other way around, if RBI is selling dollars and buying rupee, it will have a negative impact on the dollar and a positive impact on the rupee. So capital flows, the traders positioning, or how the traders are taking positions in the market, in the derivatives market, the speculative positioning, and third, how the RBI is behaving in the market, buying or selling dollars. So these three things determine the value of the dollar rupee. You can ignore everything else as just noise. Trade, current account, simply ignore. Now, the next question comes: how, as a participant, one can track these things on a real time basis? On a real time basis, it is very difficult to track because the data is not available. One can make conjectures about, okay, the RBI is here, the FI is buying, etc., etc., but again, those are just conjectures, right? So you don't know it for sure. So how do we really track? So it's very simple. We simply track the factors. So if we have to focus on what determines, or if India is becoming attractive for the FII or for FDI or for the NRIs, then there is a higher probability that money will flow. So the trader, the speculator, assuming that money will flow, will start taking a short position on the dollar and start buying the rupee. So this guy is going to move. So when he is going to take a short position on the dollar, it's going to create a downward pressure on the dollar rupee. Now, RBI is an autonomous factor. We have to see from time to time. So between these two, there is a huge link. If India is becoming an unattractive place for investors, then people in the derivatives market will start buying dollars and start selling the rupees. So that's how you can gauge which way the capital flow will happen, by simply tracking the factors. Now this chart gives you a glimpse of how, since 2017, how this picture has changed. Uh, we have captured FI participation in the equity markets as well as debt, and how the dollar rupee has behaved. 2017 was all inflows. India, India, India. Oil was low, political stability was there, no issues with the central bank, and we saw big flows into both the segments, and the rupee appreciated from 68 odd to 63. It could have appreciated much more if RBI had not bought dollars in tons. So they really capped the scope of appreciation of the Indian rupee. Now in 2018, it was a completely a different story, because what we saw is the Indian rupee started to depreciate considerably, because the inflows reversed to outflows. Why? One is oil, because oil jumped by 30, almost what, 35% or 33% this year. And also of the, it's a pre-election year, we have the political risk, and also the emerging market as a whole saw an outflow, because Chinese economy is slowing down, Fed is hiking rates, and trade war is also destabilizing the emerging market economy. So all those factors, trade, oil, US rates, they hurt the emerging markets, they hurt Indian flows. And what happens to the rupee? Bam, she goes from 63.30 all the way up to almost 74 half. Now things have corrected. 69, 50, 60 it had come down to, bounce back to 72. Now today it had come to 69.90. So because the flows have again picked up since November, it's continuing in December too. So that is supporting the Indian rupee. Now the factors. Now factors can be say segregated into two halves. One is the domestic factors, and obviously international factors, because say a dollar rupee or any currency for that matter is like a beauty contest. Whoever wins is not the prettiest in the world. It's just that he or she is the prettiest in that room. So we are always comparing the Indian rupee to the dollar, and the dollar to the rupee. So Indian economy to the US economy. So the ranking determines which way the flows will happen. So in domestic factors, what we watch is, first is growth, very important, because if the Indian economy is expected to grow faster than the US economy in the coming quarters and years, then a lot of people who are looking to invest into India, be in stocks, bonds, or even into factories and buildings, would love to do so. That is good news for the Indian rupee. So growth is important. Then the real interest rates, and unless the growth outlook is positive, it's very hard to keep the interest rates high. So these two are connected. So if the real interest rate means what? Interest rates after inflation. So if interest rates are in India at 8% and inflation is 10%, you are getting zero. In fact, you are paying to invest your money at 8%, because your money is losing value at the rate of 10%. In economics language, we say your real interest rates is minus 2%, because it's 8 minus 10. Currently in India, inflation has been low since 2014 because of number of factors, global factors, domestic factors. and the interest rates have been high. So the real interest rate has been consistently high it has ever been in a long, long time. And that is the reason why rupee, in spite of all this volatility, is still very, very stable than it was between 2011 to 2013, when the real interest rates were negative. And then we come to the politics, which is a very important, because this is a pre-election year. And if there is political instability in the coming elections, then that can override higher real interest rates, can override the improved growth outlook, because people will be scared. So politics may not matter on every year, but it does matter on an election year. So keep a mind on that. And this is just not the case for India, it's also the case for America. If they have political instability, it's bad news for the US dollar. If they have a weak growth outlook, bad news for the US dollar. If the interest rates are not expected to rise and come down, bad news for the US dollar. And the fourth factor is financial stability. Now, this is not a factor which really affects every time. Time to time, depending on the context, like it happened with the NBFCs. There was a fear that some of them can default. Good that it did not happen as of now. Now, if such a thing would have transpired, it would have hit the investor confidence, because any blow-ups in the credit market has a major impact across the economy and financial markets, because the last thing a person investing in a interest-bearing asset, for example, a bond or debt, want or can stomach is a loss of capital. For an equity investor, a loss of capital is a game of probability. He takes that into the stride, or she takes that into the stride. But for somebody who is investing in debt, the loss of capital is not even considered. So when such a thing happens quite widespread, it creates a panic across the board, across markets. And we have seen say issues in the past, like in 2011 and 12, when in Eurozone we had a number of defaults in the financial sector with the real estate players, and how the contagion spread all over the world. Another example, in 2007 and 8, when we had a number of defaults in the US financial system, how that rocked the world. So whenever there is a financial instability or a risk of default starts to rise in any economy, the impact can be quite severe. It will override everything, politics, growth. In fact, it will say cripple growth, because nobody starts to lend. Everybody starts to doubt each other. When that happens, nobody lends, no credit, no growth. So it has an impact on growth, it has an impact on interest rate, and obviously it has an indirect impact on politics. So this becomes an important factor from time to time. Right now, with the NBFC crisis no longer making headlines, probably we have seen the end of it for now. So which is going to be the important factor in the next 6 months? It is going to be politics from the domestic factors. Now, this is a few charts how things have shaped. The real interest rates in India, as I said, is pretty high, which is a major stabilizing factor for the rupee, the white line, compared to the US. The US real interest rates have also increased, and which is has been one of the major reasons why dollar has appreciated against many of the currencies, including the rupee. But keeping the real interest rates high can also have say a negative impact on the economy as a whole, because high real interest rate is a tax on the borrower. So if you keep it's like a rubber band. If you stretch it too far, it's going to snap. It's going to create conditions where it snaps, because the borrower can't absorb it. The borrower can't absorb it. The economic activity slows. That compels the central banks to cut rates. So we're already seeing a lot of complaint now in America about high real interest rates. We're also seeing a lot of complaint in India as well, especially the MSMEs, who are complaining that at these rates of interest, it's impossible to do business on a scale. which which are actually sensible complaints and demands. So probably we may see the interest rates come down in India at least. But still, on an absolute basis, the real interest rates are high, and that is good news for attracting flows into India, because the people who are looking to invest in Indian debt or Indian FDs, say an NRI abroad, would love that kind of a climate where interest rates are high and inflation is low, because that gives a lot of stability to the currency as a whole, and that's a big risk when you're uh, as a foreigner, you're looking to invest in any foreign country, because you don't want to invest in a country where the currency can weaken substantially, because it can ensure that you not get any returns and even incur losses on a dollar basis. Next is growth. What we see is growth in India has recovered quite significantly since the double blow of demonetization and GST. So again, growth is improving, and what we see in America, the growth is slowing down, the growth momentum. So finally, this will have an impact on the interest rates and on the currency, and we are seeing that the dollar rupee has peaked out, and it is trying to come down. So growth is in favor of India. Financial stability, okay, as I said, the NBFC thing is behind us, so it is no longer a factor as of now. Yeah, the politics is a big one. It's going to have an impact. We already had the state elections, and they have not gone the way the market would have liked. But at least the markets have not, reacted so adversely. They did so for a couple of days. It went to it went to 72 half, and it has come down. So this is going to be a big factor. Now into international currencies. This is big, because internationally you have to look at three factors. The most important out of that is what is happening to the dollar against the other emerging market currencies. Then it's crude oil, and then in how the emerging market equities are doing. If the dollar is falling against all major currencies in the world, then rupee is going to benefit. If oil is low, like it is now, it is good for the Indian rupee, because we import a lot of oil. So our economy is dependent on oil imports. So when the oil prices are higher, it's a tax on the consumer. So that has impact on growth. So that's why it is important. This chart shows how the Indian rupee has tracked how the other 28 currencies have done against the US dollar. So it has a huge impact. Follow the dollar trend. Oil and rupee, the correlation is not always consistent, but right now it's large. Uh, this is the emerging market equities. Again, the correlation is tight. If there is money flowing into emerging markets, emerging market currencies will do well, and so the rupee. Now, this is the sentiments which we track in the market, the traders' positioning, which has an impact. And this is a little old chart. Currently, the sentiment has again turned into oversold zone. So we are seeing that's the reason why the dollar rupee is not really sustaining below 70 even today, because the sentiment has again turned quite oversold on the dollar. So this is one more indicator which we watch, which is termed as the risk reversal. This is the RBI reserves. We have seen a sharp drop in 2018 because the RBI has been selling dollars consistently to protect the rupee. Last year was a different issue, thing, because now they were building up reserves to prevent the Indian rupee from appreciating by in a big way. Now, what are the kinds of trading which you can do? You can do, I'll explain this with examples. Like this is the intraday trade. If you're doing intraday trades, like on a 15-minute chart on dollar rupee, this is an example. What do you do? This is a line chart. You see the places of demand and supply. So this was a place of demand. You put a 10 to, let's say a 10 paisa stop, which is below this. When the dollar rupee came here close, you buy. Uh, Say similarly here, this is a place of supply. You put a 10 paisa stop over this stop, and you can sell. So such opportunities will keep propping up on an intraday basis. This is a swing trade which can last for 1 day or 2 days, and which you can do on an hourly chart. Very simple. You look at the trend line. Whenever the dollar rupee is coming close to the trend line, you buy, because this was an uptrend. That's the reason why the same thing can be done for the shorts as well, and put a stop below. This is a positional trade for people who want to do it for like weeks and months. So this was a multi-year breakout which happened. So as long as this level is like when this happened, we went long, and we went long from 6920 all the way up to 74 half. So that's how the positional trades can be done. But in a positional trade, the stop losses are large. It's around a rupee to 1.5 rupees. So you can execute such things through options. This is a event-driven trade. We did this trade just around the state elections, and the payoff was massive, because it was just not the three states that BJP lost, but also the RBI governor resigned. So next day, a dollar rupee had gapped up by almost like 1 rupee 20 paisa, and the payoffs were quite massive. So such trades can be done through options on an event-driven day. Now the view ahead. First thing, what we see for the US economy is that the US economic momentum is starting to fade. This is the white line, and the US economic surprise index basically tracks the US economic momentum, and that is weak. And that's the reason why the euro line, that is where the interest rates, where the federal fund rate, which means the US central bank rates are expected to be 1 year from now, is constantly falling, is falling. And that is one of the reasons why the Indian rupee has been a beneficiary of that, because if interest rates are expected to not go up much in America, then it is good news for the inflows, because it can again turn towards India from America, as I said in that factor analysis. Now this is what happened to the dollar rupee between Jan to October, and since November of this year. Complete contrast. Since the end of October, what we see, Indian rupee has almost outperformed everybody in its against the major currencies. And between Jan and October, we were one of the worst performers. Why? Because oil is a big factor. Between Jan and October, oil was up 33%. Between November, or say mid-October to now, oil is down 35%. There's been a complete reversal in oil prices, and see what has been the impact on the rupee. Because lower oil prices means lower imported inflation, a lot of money flow into Indian bonds and equities. That's fantastic news for the rupee. It's not all hunky-dory. There are dark clouds or areas of concern. For example, the rally which we are seeing in Indian equities in the large caps, it doesn't have that kind of participations in the mid and the small caps. So just look at the small cap index. It's barely budging from the lows. And ideally, in a bull market, should have a widespread participation. Mid, small cap, large cap, everything should rally. You can have those interim pause, but not this kind of a divergence. So that is the concerning part, because such things, when they persist for some time, become a point of a sign of a reversal and a start of a bear market. So keep an eye on this. This is the long-term chart of dollar rupee. What we see is that the 68.80, 68.50, this zone was a 5-year resistance that broke. It pushed up. It has come. It's still not there at those levels back. It came down to 69.5, 69.60, and today 69.90. It's actually bouncing off this trend line. So the primary view is still upward for the dollar, as long as at least it is above the 69.60 mark. If it breaks down below 69.60, the bulls, the dollar bears, get a first taste of blood, because then they can really attack this line, the white line. Once that breaks, then this entire uptrend is over. So 69.60 is a very important support level. Now let's look at what is happening to the sentiments. Wow. What we see, as I said before, the sentiments have dropped two levels where it can be said that it is now oversold, the white line. So there is too much of dollar shorts in the market. So we have a situation where the dollar rupee is around the support level. We have is being supported by too much of short positions in the dollar. Yes, it can always fall, but the risk to reward doesn't favor a short position in the dollar. We have been short on the dollar since say 73 when it started to break down here here at 73 when we went from long to short, our view changed and we continued to ride the entire drop. Above 71 we turned long, and again around 72 we turned short. So we have covered our shorts today in the morning, and we are waiting for a rebound towards 71 or 71 half levels. So that is now the view, because as I said, the sentiment is too bearish on the dollar, so it makes sense to be cautious on dollar shorts. Now, before I conclude, I'll just take you through a couple of mistakes. This I have done in all my previous webinars because it's important. First, please have stop losses. It's very important because that keeps you in the game. It's a trader's place. A trader without a stop loss is not a trader at all. It's a dead horse. So one is a stop loss. The next is don't average in losses, which is very important. So having a stop loss would prevent you from doing the second one. And don't take too large a position. As a rule of thumb, you should not commit more than 2% of the total capital in one trade. Excuse me. So with this, I move to the last round, which to do with the questions, and we have received a number of questions. So first, let me just scroll through and see which are the important ones. So there is a question from Nishant, and he asks, what will be the rupee against dollar by Feb 2019? I don't know from where did he pick that particular month, but let's say by March, because that's the financial year end. There is a possibility that we may see the dollar rupee back to the levels of around 69 half and 70 levels, because if there is going to be a political uncertainty in America, it could happen in the first quarter of the next calendar year, that's 2019, between Jan and March, for the simple reason that the new Congress, who have been voted to power in the last November elections, will be in session from January. So we can expect the confrontation between the President Trump and them, because they are from two different parties. So that can lead to a lot of issues, including the possibility that the budget may not be passed and the government may shut down, which all these things can be bad news for the dollar. If that's the case, then we can see once again the levels of 69.5 and even a test of 69. But if there is a global stock market meltdown, and if there is issues with China, which is again global in nature, then we may have seen the bottom around 69.5, because that's also the trend line which I had shown you, and we may see the Indian rupee head back towards the levels of 72. So this is where the range looks like, depending on which way the factors swing. Let's take the next question. That's from Oil Rupee. This is a question from Mr. Patel. Mr. Pradeep Patel. He asked oil, rupee, and general election impact in the next 9 months' time. What's your take for dollar and interest rate cycle in the US? Fantastic question. I would say 6 months because in this 6 months we will have the elections here. Uh, Oil looks like will stay low. That's good news for the Indian rupee. U.S. interest rates, U.S. economy is slowing, and if the oil prices stay low, that means inflationary pressures will be low. So lower growth, political uncertainty, and lower inflation would mean that the U.S. interest rates may not rise much. Probably one more hike over the next 6 months from US. So that's good news for the rupee. But as I said, the wild card the elephant in the room is the global equity market. If the global equities continue to melt down because of the US stock market falling or because of the Chinese economy going into a turmoil, that will override all these things and it will compel the Indian rupee to depreciate against the dollar because outflows, when they happen across the board from emerging market, it even impacts the India. That's exactly what happened in 2015 after May, when oil was plunging. It went all the way down to 27. Indian stock market Nifty fell around 28%, if I'm not wrong, and Indian rupee went from 64 or 63, 64 all the way to 68.80 by Feb 2016. Though Indian rupee was depreciating against the dollar, but we were appreciating against every other currency in the world. So such an optical illusion can happen once again. So this time we are appreciating against the dollar, and we have also appreciated against everything else over the past 2 months, almost 2 months since end October. But even such things have happened where, you know, if you're looking at the dollar, we are weak. But if you're looking at every other currency, we are the strongest. So such things can happen. So currency market, the context can be quite tricky. So that's why we give far more importance to charts when we trade and how the international equities are doing, currencies are doing, Brent is doing on a daily basis when we are trading, just looking at long-term factors. So that is the advantage of being a trader in this market because you can keep it simple and short. Now let's take the next question. Just a moment. What maybe this is a question from Mr. P.D. Baloni, and he asked that what may be 2019 general election scenario. It's very hard to call the election, but considering what has happened in the state election, it could be between whether there's going to be a hung parliament or a majority government. Hung parliament is bad news, majority government is fantastic news. A lot of the other questions on dollar P we have already covered. What will be the US dollar range in the year 2019 is going to be quite volatile. This is a question from Mr. TP Singh, and 69 looks to be the floor as of now because of a number of technical reasons as I had outlined, and 73, 74 could be the upper end. But again, this is kind of, I am groping in the dark here because there are so many factors which can lead to significant amounts of volatility. So one can say is that 69 technically speaking to is a very, very important support because it was a major resistance. So 69 seems to be the floor as of now. You can always come there, test it, double around there, go below it, and spend a couple of weeks and then bounce back. That can always happen. But that 69 seems to be the floor. Upside we have to see. Just because 74.5 is the all-time high, so we can say 74.5 is then now the cap. But if things change, then obviously something else will be the ceiling. So accordingly, we have to proceed. Our next question. There's an interesting question from Mr. Joe Koshi, and he asked that we hear that RBI has come in to buy or sell USD INR. Will this not affect our trading model as they are insiders who want to manage the currency to suit the need? Fantastic question. Yes, they're not an insider. See, when we say insider, it means somebody has privileged information, or what we term in the language of CFA is material non-public information, something which can have a material impact on that particular instrument. In this case, a stock. Let's say a big merger is going to be announced, and this CFO of that company has that information and the privilege, so he starts to buy the stock. That's material non-public information, and he is an insider. That would tantamount to a violation, or in this case, the edge in the market. But RBI is simply a brute force. They don't have any information about anything, because in a currency, nobody's an insider. Yes, it will affect the price, but if you build a trading model like we do, which is over based on all these kind of activities which they have done in the past, it takes that into account, and the stop losses are always there. So those are not really factors. You can still trade it in spite of the RBI. In fact, a lot of the times we have seen the charts front run the RBI, as if the charts create the pattern where the RBI simply provides the momentum. Next question is, I think this will be the final question. Let me see if I can find something interesting. How are forex trading gains and losses are taxed? This is from Mr. Shah, Ashish Shah. I'm not a tax expert, but let me hazard a guess. So this will be if you are a corporate, let's say exporter, importer, this is part of your business income. So if you're hedging on the exchange or you're hedging on the OTC, it doesn't matter. The tax treatment is same. It is part of your business income and loss. So it will be simply be included there. If you're an individual, this will be taxed at your marginal tax rate. And they have a carryover. Those things I think you have to find out. I'm not an expert in that. So that's it. Thank you once again to all of you for being here today. And I hope that you enjoyed it and found this webinar informative. With this, namaskar.